Welcome back, everyone. I'm Adam Sampson, and I'll be chairing proceedings for the rest of the day until 5:25 UK time, when our live stream of the in-person gathering in London will kick off with opening remarks from the FT's deputy editor, Patrick Jenkins. For now, though, it's back to Joy McKnight, who'll be interviewing the head of the Monetary Authority of Singapore, Ravi Menon. Back to you, Joy.
Hello, and thanks for joining what I'm sure will be a very interesting central bank keynote interview. As Adam mentioned, I'm Joy McKnight, editor of The Banker, and I'm pleased to have Ravi Menon, Managing Director of Monetary Authority of Singapore, which is Singapore's central bank and regulator, with me today. So MAS is a leader among central banks and regulators, and many contemporaries and financial institutions across the globe closely follow its efforts to support innovation in finance and fintech. It has taken a lead in central bank digital currencies and has worked with the Bank for International Settlements on cross-border CBDC experiments, such as Project Dunbar, but we'll discuss that a wee bit later. So Ravi, thanks so much for joining me. Maybe my first question is, what guides MAS's approach to the cryptocurrency market and ecosystem? And then also, how has your thinking really evolved over the past few years?
Thank you, Joy, and thanks to the FT and Banker for having me. It's a delight to join this summit. So I think it's just appropriate that you've termed the summit devoted to digital assets, digital and crypto assets, which I think is the right way of phrasing it rather than cryptocurrencies, because we need to look at the larger crypto ecosystem, of which cryptocurrencies are just a small part. Although they have attracted the bulk of the attention. So maybe just to step back and unpack what this ecosystem is about. There are three distinguishing features in a crypto that make up the crypto ecosystem. First, the blockchain, basically a distributed ledger where ownership of assets is recorded and verified, and transactions take place peer-to-peer and are irrevocable. So first you have the blockchain. Second, you have the concept of tokenization, and this is what distinguishes it. So tokenization enables all manner of assets or any items of value, real assets or financial assets, to be represented digitally through a smart contract on the blockchain. And then third, you have cryptography. So this is a secure way for transactions to be performed. Example, through a public key that allows users to receive the tokens into their accounts, and a private key that allows only the owner to access the token and transfer it. So blockchain, tokenization, and encryption. So taken together, these features make the crypto ecosystem potentially a transformative technology. And the key value proposition is this: by representing assets digitally, the crypto ecosystem enables high-value assets to be fractionalized and previously unmonetized assets to be monetized. So when you have that, you can unlock new economic value, enhance financial inclusion, and enable more seamless and efficient financial services. So this is the greater vision that the MAS is focused on. So it goes much beyond cryptocurrencies. Now, given this vision, what's our approach been, which is what you've just asked? How do we build this crypto ecosystem, which we think is going to be critical for the future? Well, two parts to our approach. One is to grow capabilities, and two is to manage the risks. So first, we want to grow broader digital asset capabilities. The digital asset ecosystem comprises an entire range of crypto-related services. So you have trading, you have custody, brokering, and tokenization itself, and the blockchain protocol development. So all these are parts of the capabilities you need. And we're working very hard to enable a conducive environment for such activities to flourish in Singapore. So we've taken steps to clarify the tax treatment, for instance. We are encouraging talent development. We're providing grants to bring in some of this innovation. And we're collaborating with industry to explore the potential of blockchain technology through real value infrastructure experiments. We're also working to anchor and have been quite successful in anchoring high quality strategic players at the forefront of digital asset innovation. And these players offer very strong value propositions. So JP Morgan, for instance, partnered DBS Bank and Temasek to establish Partior, which is a multi-currency cross-border settlement platform leveraging blockchain technology. R3, very well known in the UK, a global distributed ledger technology provider, has grown its innovation hub in Singapore to be the regional headquarters for Asia. So that's all about building capabilities. Now, it will not succeed if we do not manage the risks well. And there are 4 risks in the crypto ecosystem that MAS is watching closely. First, money laundering and terrorism financing risks. That's one class. Second, technology risks and cyber risks. Third, consumer protection. And fourth, potentially financial stability. Now, the approach we've taken is to regulate digital asset related services and service providers on an activity basis rather than an entity based approach. So we're trying to mitigate the specific risks posed by specific activities while allowing latitude for innovation. The risks depend on the underlying characteristics of the digital asset. So you can't have a one size fits all approach towards regulation of digital assets. So if the digital asset represents a security, for instance, a share or a bond, it is then regulated under the Securities and Futures Act in the same manner as all capital market providers issued through traditional means. So same risk, same activity, same regulation. Now, if the digital asset is used as a means of payment, which is a different class of tokens, then it is regulated as a digital payment token under the Payment Services Act, which is a different piece of legislation. So in the last 2 years, we've granted licenses or in principle approvals to 11 digital payment token service providers just in the last 2 years. And they include, well-known players, stablecoin players like Paxos, crypto exchanges like CoinHeco, as well as established financial institutions like DBS Vickers. We've also issued in principle approvals to Revolut, well-known in the UK, and Luno just this week. The licensing process is stringent, I should say, and it needs to be because we want to be a responsible global crypto hub with innovative players, but also with strong risk management capabilities. We only approve applicants with strong governance structures, fit and proper board and management, and we go through what their track record is. And they need to be familiar with money laundering, terrorist financing risks. For the digital payment token providers, service providers, regulation has been limited to anti-money laundering, technology risk, and access to retail public. We've taken quite a tough line against this, that we do not want them to have unfettered access to retail public because we're not sure that's a good idea for retail investors to be dabbling in cryptocurrencies. And these are not unique to the MAS. I think many global regulators share similar concerns about retail exposure to cryptocurrencies. So our approach, we'll continue to adopt adaptive, continually evolving and consultative approach to regulating this fast-moving space. We use guidance before we use legislation. So if you're not sure of something, issue guidance first. This is the approach we've taken for marketing of digital payment tokens to the general public. Rather than use regulation, we've issued guidance. You should not market this to the general public for retail investors. We do a lot of public consultations and industry consultations on new areas of regulation so that we get it right. For instance, on the issue of stable coins, that's one of the key issues that we're currently looking at. And basically, we want to continue to provide clarity to the industry on our regulatory thinking and our concerns, at the same time leaving the door open for opportunities to co-create solutions with industry. I'll stop here.
Excellent. Yeah, excellent. What I was wondering is, obviously MAS is further along in terms of, you've been doing this for at least maybe 5-7 years in terms of creating your framework. What do you think that other central bankers or regulators in other jurisdictions, what do you think they can take away from some of, or what sort of learnings do you think that they could take away from what you've done already?
Well, I think, as I said, one of the things that would be useful is to be clear about the specific risks that are being posed and to regulate for those risks, right? We want to do this in a way that surgically addresses the risks that the crypto economy provides, or the crypto ecosystem provides or poses, while maximizing the space they have for innovation. So, which is why we've taken an activity-based approach. And as I said, what the international community could do more of is to itemize these risks rather than to speak of them as a blanket of risks. So money laundering risks are quite a specific kind of risk, which requires a specific kind of regulation and certain expectations that need to be met. Technology and cyber related risks, very important in this space. We need to make sure they manage the technology risks well. Third, investor protection or customer protection. And there are various ways of getting around it. In some jurisdictions, they look at cryptos as commodities and then use that set of rules to address it. In others, they look at it as a security. And here we look at it not as any particular product, but depending on the characteristic of the underlying asset, whether it's a security or a payment token. So, and internationally, I think one of the issues we do need to address is the question of stable coins. They're gaining in prominence, and I do think they're promising, but we need to be sure that the backing for these stable coins is really there, because you are selling stable coins as being pegged as equivalent in value to fiat currencies. It's almost as good as a deposit. If that's the case, then we got to pay close attention to how much of this backing is real, is liquid and available when it's required. So many issues of this sort that I think regulators can learn from one another. And I can tell you at the BIS and the Financial Stability Board, very active discussions on these issues, exchanging experiences and views. But there's a very clear understanding that we do need to regulate this space. We got to figure out how and where we do the regulation.
Excellent. And my next question is around what are the main criteria that the MAS considers when you're thinking about licensing crypto services or issuing crypto service licenses?
So, as I said, it'll be mostly the ability to manage their risks. And I'll come to the risks in particular. What are the requirements that we have? Having a strong board and management is important, a strong risk governance culture, and capabilities. So these are the things that we look at very carefully. Many of them are young players with little experience of banking or regulated activities. So there's a culture issue to bridge. They are innovative, they're nimble, they think out of the box, which is all great. We want that, but they do need to have a risk governance culture. And so that's something we pay close attention to. The primary risk we see at this point that is inherent in the nature of crypto service the crypto activities is money laundering and terrorist financing risks. I would put that at the top of the list. I don't think at this point they pose serious financial stability risks, although it's something that the MAS and other regulators are watching very closely. There is potential for it. There is some leverage among these players that is of some concern. There are exposures that banks have towards these players that we need to watch closely. But I would put money laundering risks at the top of the line. What do we expect of them? First, they need to do risk assessment of new products and technologies. These crypto players need to have a formalized approach to identify and assess the money laundering and terrorist financing risks before they offer new products and technologies. So, for example, the risk assessment should consider whether a product has characteristics that promote anonymity, whether the product is known to be used by criminals for illicit purposes, and whether the volatility and liquidity of the product renders it susceptible to market manipulation, fraud, and so on. So they need to do this risk assessment before they launch products. Second, customer due diligence. They need to conduct proper customer due diligence from the very first dollar for all digital payment transactions. So this is non-negotiable. If a potential customer is assessed to have higher money laundering risk, for instance, then we expect the crypto service provider to take enhanced customer due diligence measures to mitigate, manage these risks, establish the customer's source of wealth, the source of funds, destination, and so on. All the stuff that we expect banks to do, we expect them to do on the money laundering front. Ongoing monitoring, this is also important. They should monitor the business relations with customers on an ongoing basis, ensure that transactions are consistent with their knowledge of the customer, the business, its risk profile, all these things. Fourth, I would say compliance with the value transfer rules. So when value transfers are made between the digital or crypto service providers on customers' behalf, the service providers must show that they have measures in place to transmit the necessary originator and beneficiary information to the beneficiary digital service providers immediately and securely. So both parties know who the beneficial owner is, who the originator is. We also look for technology risk management. Now, these players are pretty good with their technology, but doesn't mean that they are adept in all areas of technology risk management. So they are expected to comply with the MAS's technology risk management guidelines. We've also set out cyber hygiene requirements for all financial institutions in Singapore. Basic cyber hygiene practices, control of access to accounts, authentication, and so on. This applies to the crypto service providers too. They need to also meet cyber hygiene requirements. Basically, you need to ensure the reliability of their critical IT systems and the ability to protect customer information from unauthorized access or disclosure. So these are the things that we look out for when we license. Do they have the capabilities to do these things? Because these are all going to be requirements once we issue the license.
Excellent. Well, I want to get into the nitty-gritty of Project Dunbar, which MAS did with the BIS, as well as some other central banks around the world. Can you give us a sort of high-level explanation of what Project Dunbar is, what were the main takeaways, and then what are the next steps for MAS?
Yeah. So this is exciting work that we're doing with the Bank for International Settlements, also together with Bank Negara Malaysia, South Africa Reserve Bank, and the Reserve Bank of Australia. The problem that we are all trying to solve is cross-border payments. Cross-border payments and settlements, right? You want, the holy grail is instantaneous payments and instantaneous settlements or close to real-time settlement, so that you remove risk of, uncollateralized positions and at low cost and very high security. So today, if you look at the cross-border payments landscape, it's far from that, very far from that. So this is a problem we need to solve. G20 has focused on this, and the Financial Stability Board has focused on this. So Project Dunbar is an attempt to do this, focusing on a shared platform that would enable international settlements using digital currencies issued by multiple central banks. The MAS has experimented bilaterally with the Bank of Canada under Project Ubin, going back a few years. We are now trying to scale that through this effort with the BIS to have multiple CBDCs issued by central banks for the purpose of payments and settlements within a platform, within a decentralized platform. We also want to use the opportunity to identify the challenges of implementing such a multi-CBDC platform that is shared across central banks. What are the design solutions you need and to address some of the challenges? So this second objective is just as important as the first one about technology. Issues like governance, for instance. This is not about technology, but how to get multiple central banks to share a common platform and mitigate national security concerns that are associated with sharing critical infrastructure. Because when central banks come together to issue multiple CBDCs on this platform for settlement purposes, you are in a sense exposing some of your critical infrastructure, and that's something you would be very careful about. Access. Who should participate in such a shared platform? This is another question that Dunbar is trying to address. Non-banks, we do need the non-banks in the picture, if you ask me, because not everyone has a bank account, and if you're operating out of an e-wallet, you do need non-banks, but they're not usually part of the interbank system. So how do you bring them onto this ecosystem? Then there are issues about regulations, jurisdictional boundaries, how to reconcile different laws, regulations, guidelines, protocols that govern payments. So none of these are technology issues, but actually they are more, I would say, more challenging than even the technology issues. And the degree of harmonization that's required is not trivial. So we just finished phase 1 of Project Dunbar. So I think they've come up with a blueprint that can facilitate future discussions on some of these key issues that are not resolved yet. But basically, we want a common settlement platform where the central banks of the world can come together, issue wholesale CBDCs to effect cross-border payments. And that is the dream that we are working towards. And I hope in the region we will see the germ of such a platform in the not too distant future. Thanks.
Excellent. Well, I'm very excited to hear more about it as it progresses. We have a question from the audience, which is, first, thanks you for your insights and your vision, and asks, should regulators work together and implement a Know Your Token, or KYT framework, given the global nature of these assets?
That would be ideal. I think the place where this is likely to make the most progress is the FATF, the Financial Action Task Force. It has been quite progressive in issuing guidance on the treatment of what they call, their terminology is virtual asset service providers, VASPs, right? And for a start, they have said you need KYC on the customer who is operating your e-wallet, right? So, and that's something the MAS has insisted on. So every player on the blockchain who has operated an e-wallet for the purpose of making transactions, KYC kicks in. The next step is to know the token. What is the token about? Because what is the underlying asset of the token that is giving rise to this transaction? I think we need to know that, because in the traditional banking world, you do want to know the source of funds. So I think you do want to know, you want to have more clarity about the nature of the asset. So I think the question is quite spot on. But to be quite realistic, I think that discussion is still in very early stage. What I think is going to happen is that groups of countries are probably going to have such requirements. And then over time, that will get multilateralized.
Excellent. Thank you so much. It's a bit of a shame because we're running out of time. It's been so interesting, but maybe I'll just ask 2 more questions. One is around I know that the MAS has sort of ruled out introducing a digital Sing dollar for now. What circumstances do you think would facilitate introducing a central bank digital currency? And then what are the risks of doing so?
Yeah. So we find it's useful to make a distinction in the category of central bank digital currencies between a retail CBDC and a wholesale CBDC. MAS has already issued a wholesale CBDC. We did that 4 or 5 years ago as part of Project Ubin, which I mentioned, where to effect the transfer across borders, we issued a wholesale Singapore CBDC. That is used to facilitate the transaction in the blockchain, to effect the payment and settlement, and then it gets extinguished. So wholesale CBDCs are contained within the banking system. And I think they play a powerful role in all cross-border kinds of situations. A retail CBDC is a central bank digital currency that issued to members of the public, which means instead of you and I having an account with our bank, we have an account with the central bank. This is a direct liability of the central bank to the general public. That's a retail CBDC. That is what we've said. We're not sure we need one right now. What is the problem it is trying to solve? It's not very clear. Whereas for wholesale CBDC, it's very clear. The problem statement is cross-border payments and settlements, right? Because there's no global central bank. And so because there's no global central bank to do the settlement, you need a distributed ledger and you need wholesale CBDCs and an exchange rate among them to make the cross-border payment seamless. But what is the use case for a retail CBDC? Today, 95% of our money is already in digital form, in the form of bank deposits. We transfer those deposits either through our debit or credit card or our faster pay systems or our e-wallets, digital to digital. Not inconceivable that many countries will come down to very low usage of cash. So all the advantages that you have of financial inclusion through expansion of digital money, we already have. In Singapore, I think as with the UK, electronic payments have become very pervasive. It's cheap, fast, instantaneous. You can transfer money from one bank account to another, but just knowing the other person's mobile number, or if it's a corporation or a firm, the unique identifying number, 3 clicks on your mobile phone, money gets transferred at zero cost, securely. So when you have that, it's not clear to me what purpose a retail CBDC provides. As long as you have strong growth in all these innovative private sector solutions, why hold CBDC at the central bank? It will not be a minor decision, because if at some point we think we might need it, we'll have to be conscious of the risks. So with, in a sense, rehearsing the future. So we're doing this on 2 tracks. One, although we don't have an intention to issue one, we want to make sure we have the technological capability to issue one if the need arises. And also the governance and policy frameworks. Because this is not an easy solution. This is not an easy matter. If the central bank were to hold CBDCs, in the form of money held by the general public, that means it's a migration of some amount of deposits from the banks to the central bank. Is that a good idea? What happens to the credit creation process? Central banks are not in the business of lending money to businesses. Banks have the competence to do that. So when deposits are transferred to the central bank, you may actually interfere with the credit creation process. So I think these are risks that you need to think hard about. And it's not impossible to solve these problems. You can set limits to how much CBDC people can hold. And basically, it's not even a monetary question. I think it's a social or political question. Does the general public want to hold digital cash? Today, they hold notes and coins. We all hold a small amount of notes and coins because if we can't use digital payments, we can use cash. In future, if cash disappears, do you want to have a digital form of cash with the central bank that you can then move around? From a monetary or economic point of view, there's no necessity. But if socially people want that, then it becomes incumbent on the government and central banks to look for those options. So I think that's where we stand today, keeping an open mind, not ruling it out. But for now, we don't think that is the biggest problem to solve. We got a lot of other fish to fry. So we'll watch this case closely. Thanks.
Excellent. So we have less than a minute, I'm afraid, but I just wanted to ask you your opinion about decentralized finance, or otherwise called DeFi. Is it the future? So yeah, it's 30 seconds.
It could be part of the future. I think it will be part of the future. I don't think it will be the future. There will be a need and a case for having direct peer-to-peer financial services being provided through decentralized protocols like the blockchain in a Web 3.0 world. Smart contracts that are self-executing. You don't need an intermediary. I can imagine quite a tight range of simple financial services that could be provided in that way. And that will disintermediate the banks to some extent. But I think there'll be a large category of financial services which will still require customization, which will still require a degree of trust and direct connection between a financial institution and a financial customer. And those, I think, will continue. So I think the two will coexist, but it will be a very interesting dynamic to watch in the coming years. Thank you.
Okay, great. Thank you so much, Ravi, for your insights. It's been such a pleasure speaking with you. And thank the audience, our audience, for watching. Just a reminder that the session is available on demand on the website for 90 days. Now back to Adam and Katie in the studio.
Thanks, Joy. Great hearing such nuanced thoughts from Ravi on CBDCs and DeFi in general. Coming up after the break, it's time for our NFT panel. Is the NFT craze dying or entering a new phase? Find out soon.